a little bit better than we were yesterday. That's all we're trying
every
to be.
day, every
Every day.
day. So there's the confirmation we're
Hey,
recording.
folks, this is Bill and Brian with Energy Rogue. We are coming at you today just because we saw a few interesting things yesterday. We wanted to share it with you. Brian, well, let's talk about Haynesville. Let's talk about northern Louisiana, Bossier Sand, all that good stuff.
Well, Haynesville is one that has always been kind of interesting in that it holds so much potential because these come on at a high rate. Once the shale revolution really happened in the mid 2000s, we had this dramatic increase with high IP rates, high pressure, and really found a lot of volume on natural gas. And with the rise on natural gas prices, something that we found interesting when we were looking the other day. Let me switch over to
Pull up some of those magic Energy Rogue charts.
this one. This one. Okay. Yes. So you can see my screen, correct?
Correct.
All right. So what we looked at was the fact if you look at the rise in commodity prices, and we have drilled and uncompletes on Rogue Edge. So come join us. Come join us because we have over 100 interactive charts, and it's all there for you so that you can digest the data so that you can look at things in the market in a unique way. So that's what we provide, and it's only $89 a month for Rogue Edge. If you're not quite ready to step to that, $30 a month, and you'll get a daily email with a little bit of market perspective. But one thing that is interesting is there is a phenomenon or industry term called DUCs, drilled uncompleted. Now, oftentimes this can be for managing costs. So you drill this and you save on the completion cost for a later date. So sometimes the E&Ps use that as a cost management, but typically what you often see is that sometimes this means that the resource or the volume that's coming out is waiting on infrastructure. Now that infrastructure could be a processing plant, it could be a gathering line, it could be a transmission line. It really just depends. So a lot of times it's capacity related. And as you can see, from 2018 to 2020, we just had a lot of drilled and uncompletes. And then what happened is in COVID, and it continued even further, this is when that inventory of drilled and incomplete dropped. So all the producers went back as a cash management and completed this. And a lot of it was because infrastructure was completed. So they could bring on those wells, they could complete the wells. So when we look at this shape, from this time frame on, from 2020, we went from a very high level of ducks to a very low level of ducks. So what Bill and I were looking at is Anadarko went down, Bakken went down, Eagleford went down, Haynesville, wait, what? Haynesville, why is that up? So what we have looked at is the fact that Haynesville is increasing in the volume of ducks. Now, scale-wise, maybe we're talking hundreds. So it's not a tremendous amount, but
Yeah,
it
because
is
Haynesville's wells are big.
that's what I mean. And when you have this type of price run where we started the year, we were in the $4 range, even down to the 3, I believe. Yep. Yeah, 3. So we've gone from $3 to a quote unquote normal between 7 and 9. And when you see that and you have high rate 20,000, 50,000 decatherms a day, now the decline rate in the first 90 days is dramatic. It's maybe I don't know, 70% decline rate, something like that. Does that sound right, Bill?
That's probably a little bit more aggressive. I would say you probably have 70% over 2 years.
Okay.
But I think you're hitting on a monthly decline rate of probably 10%. But either way, it comes on so strong, you still have a lot of well left.
Right. I mean, the main thing is that when you have 200 wells at 20 million a day, it's going to add a punch. Now,
Yes.
there is infrastructure designed for the Haynesville, and some of it is coming online later this year, about 1.2 BCF, and then early next year, another 400,000 a day is going to be coming online. And what you can see is Texoak, which is kind of indicative of where it's kind of in between Haynesville and Mid-Continent on a pricing basis. That has gotten a lot closer to the Mid-Continent basis, which tells me there are some constraints. And this is something that we're going to take a look at. But this is what you can use Rogue Edge for, is identifying a trend in the market so that you can identify opportunities or potential problems that you may encounter if you happen to be drilling a well in the Haynesville. You need to make sure that you are going to have a place to take it. So anyhow, that's what we wanted to share today. I don't have any more today on that, but we wanted to cover Haynesville today. So Bill, do you have any other thoughts?
No, I just these are the type of things that we try to discover and use the data to and sort of go where the data tell us to go look, and not something that Brian and I try to come up with on our own. The only other thing I have is that this Saturday we are at the Oilfield Tailgate at OU and versus, I think it's Kansas this week. It starts at 4 p.m. at Othello's in Norman. Listen, if you want to come, it's a great time. There's food, there's drinks. All you need to do is go to Oilfield Tailgate and sign up on their website and just use Energy Rogue as who you're coming to be the guest of. All right, Energy Rogue at Oilfield Tailgate. It's this Saturday, 4 p.m. in Norman, Othello's. It's a good time. I'll be there. Look forward to seeing you.
Yep. Thanks so much, everybody. We'll be putting out more videos soon.